Hello, and welcome to Idea to IPO. I'm Jason Putnam Gordon, an emerging growth and venture capital attorney with K&L Gates, LLP. You're here for how to do a venture capital financing. Let me give you a little bit of an overview of today's presentation before we dive in. So a few notes. I'm running all the tech in the background, so if you notice a pause or a shift, bear with me. I've done this quite a number of times, so I expect it to go smoothly, but every once in a while, there's some wrench or something that gets thrown in the works. So we'll get through it. I made it through the, I don't know, tens or hundreds I've done before. Today's event is recorded, so if you miss some or all of it, so long as you have registered, you'll be able to view it later. Additionally, the corollary to that is because it's recorded, because it will be publicly available and is publicly available, this is not a venue to share confidential information. If you have missed some of it, again, I will follow up with an email with a link later. And of course, some important caveats as we get started. Today's discussion is general information. It's not legal advice. We'll be discussing rules, we'll be discussing patterns, we'll be discussing my experience. Even if you share with me some information and I respond to it, please don't take that as guidance. Each matter, to provide competent legal guidance, the lawyer needs to know all the facts involved and also the applicable law. So don't take any of my off-the-cuff answers, whether we speak today, whether it's via chat, or even if we set up an informal informational conversation later, because I do keep office hours. Don't take that as legal guidance. We need to get engaged and run conflicts first, of course. Okay, so let me give you a little bit of an overview of today's presentation. We're going to go over my background. I'm also going to tell you a little bit about K&L Gates, which is a firm that I'm at and very excited about. We're going to cover topics such as what the venture capital model is about, how to choose venture capital investors, preliminary determinations and considerations, term sheet negotiation, deal documentation, diligence, side letters, closing and post-closing matters. We're going to try and hit your questions. It's a lot of content. It's a great topic, one of my favorite. I'm excited you're here. And again, if you've got questions, please use the Q&A as I'm not monitoring the chat. If you want to talk amongst yourselves in the chat, you feel free to do that. It's not monitored. Also, if you haven't already, please fill out the audience poll. It's helpful to know who's here in the virtual room today. We'll go over that, and let's keep chugging along. So as I mentioned at the outset, my name is Jason Putnam Gordon. I'm an emerging growth and venture capital attorney with K&L Gates, LLP. I'm based in San Francisco, California. But one of the nice things about being in San Francisco, the Bay Area, which is part of Silicon Valley, is that tech and venture, if you're in that space, if you're related to that space, eventually you're probably going to touch the Bay Area. And so I get to work with a lot of companies all over the world. I love it. I love working with entrepreneurs on financings as outside corporate counsel. I love working with investors on the same things. I play a lot of air traffic controller, which is always fun and exciting. One sort of anecdote I'd like to share is that, I'm an entrepreneur myself. Before returning to big law, I formed my own boutique and grew that and ran that for 5 years. So I know what it's like to start something from nothing. And that experience has really helped me relate to my clients. And K&L Gates is a fully integrated global law firm with nearly 2,000 attorneys and I believe 48 offices at this point on nearly 5 different continents. And that basically means that we can serve our clients from soup to nuts, whether they are emerging growth companies, whether they are investors, whether they are large corporates, whether they are academic institutions. And so as a result of that, we get to take advantage of a lot of information and bring a lot of information and experience to bear in the transactions that we work on for our clients, which help add a lot of value. It's also really valuable to be able to have a uniform platform and be able to serve clients all throughout the world. And that is absolutely one thing that drew me to the firm. And that also, I think, has been really helpful for my clients, especially as we continue to move into a world that is more and more integrated and global. So let's take a look at the audience poll, if we will. I'll freeze it here. I know there are some other folks who may not have been able to fill it out, but let's take a look with who's here. And if you're watching on a time-shifted basis, thanks for attending. We've got a strong contingent from the US, maybe in the aggregate, probably about 50%, over 55, about 65% of the people are there are from the US. In terms of other localities, we got 10% for North America, 10% from Europe. Thank you for staying up. Asia, my goodness, I appreciate it. Maybe there might be more folks from Asia or Australia. I see some folks from Australia here. Watching me on a time-shifted basis. Thank you. Thank you for attending. We've got, by and large, a lot of first-time entrepreneurs. I think you'll get a lot of value out of today's conversation, and actually a really large contingent of serial entrepreneurs. I mean, usually, I'd say, we've got 45% describe themselves as first-time entrepreneurs and 30% as serial entrepreneurs. I feel like usually we've got more first entrepreneurs and fewer serial. So gosh, I wish you were actually in the room with me today. It's always such a wonderful experience to have serial entrepreneurs in the room who can share some of their experiences. So sorry you won't be able to do that, but very glad you're here. I think you'll get a lot of value out of this, this conversation as well. And we've got some folks from academia and some venture investors. So welcome, glad to have you here. And let's keep moving along. So bear with the simple graphics. We're in the process of actually improving some of these, but I think it's always really helpful to go back and think about kind of what the venture capital model looks like. And I think one of the real takeaways is that, and we'll talk about this a little bit more as we talk about what venture investors are typically looking for and how that industry operates. But what we're trying to do and what we're trying to see is that there are going to be a lot of inputs going into a company. You've got capital, if you're coming in from investors, you've got ideas and IP coming in from founders and other folks who are employees at the company. And then you've got other folks who are providing technical skills, and you're trying to get all of those inputs in the company, add some time, allow them to do, their thing, whether that is sales, going out to market, obviously, of course, product development, in order to create the product, and see the company increase in value over time. But it doesn't just go from like teeny tiny to giant huge overnight. It takes time. And in the venture model, as we shall see, usually you can break it up into stages. So we've got sort of a life cycle of what venture capital companies kind of typically would do, or what you would see. Now, of course, it's a model. It's not the only way that things can get done, but it's, I think, a very helpful illustration of, look, initially sort of in the sort of seed financing stage, when you're first putting together your first team, you're putting together your first product and or service, there's no revenue. You're going to be raising from angel investors, friends and family around, basically. And then once you start to develop and show traction in the market, that's typically when the more traditional venture capital firms will get involved. And, at that point, they don't invest all the money that the company is going to need in order to grow. Instead, there's an agreed upon business plan with milestones, and milestones based on inflection points, right? So if, we give you this capital, you're going to, do this with it. You're going to develop this model. You're going to go out and get this regulatory license. You're going to add these salespeople. And, if we do that, we're going to start to see this revenue growth, and that will position us well for a great, next round. And of course, to truly get up to the right scale for an exit, which would be typically shooting for either an initial public offering or an M&A exit, it's going to be a couple of rounds of capital. And maybe we'll talk a little bit more about this later, but the other thing about venture investors, especially for those first-time entrepreneurs in the room, is that venture investors play in different, they're people, they have different focuses. Some are generalists, some are specialists in particular industries, and then typically they will focus on a particular stage of the life cycle. So you'll have venture capital investors who will focus on early stage companies, some on growth stage, some on late stage. So you always got to know your audience. And what we'll see on the right here, and again, these figures are just used for illustrative purposes. Don't interpret them to be applicable to your situation. But, initially what we'll see, and because this is always a topic that founders are focused on, is, what happens to the equity. And, you'll see initially the founders will have 100% of the equity. And that equity will be, in some senses, the market will not put a value on that equity. It'll be valued basically at zero. But then as the company starts to grow, and if it's successful, you'll start to see it tick up. And so although the percentage of the company that they own goes down, the value of those shares increases dramatically up and through an exit. So maybe I'll pause there and see if there are any questions, as well as take a sip of water. And if you've got questions, use the Q&A function rather than the chat, which I'm not monitoring. We've got a question about how much revenue or profit should the startups make before being considered for a venture capital investment? Great question. It's like you're sort of segueing me towards my next slide. So I'll see if there are any other questions. Otherwise, I'll tackle that as we move through the next slide. How do investors view dilution? Great question. Again, let's tackle that on the next slide. So I'm going to work that in the next one. All right. So who makes a good investor, and how can we find them? So I think maybe first, it's always good to take a step back and understand, at least in a general context, who these people, because ultimately they are people, who these people are and kind of what their motives and incentives are. So let's focus on, since we're talking about how to do a preferred stock financing, let's focus on sort of a traditional venture capital firm and kind of how that's set up. So venture capital funds are set up so that they can make money for their investors, and their investors are typically are limited partners and frequently called LPs. And again, each fund can be set up a little bit differently, but by and large, the sort of common horizon that you would expect to see is, maybe a 7 to 10 year fund life. And, in the course of that life, the first couple of years, they'll be deploying capital, and then, they'll be allowing their companies to grow. Maybe they'll also put in some additional capital. But by and large, what the expectations generally get set for the LPs are that, by the end of the life of the fund, there will be like a 3x return of the LP's investment. And the typical or common sort of investment strategy that's deployed by venture funds is that they're going to make a lot of a good number of investments, but they're going to be high risk reward and high reward investments. So there will be many investments that are unsuccessful. There'll be a few that are decent returns on capital, but there will be a couple really big winners, and from those winners, maybe it will return all the capital that is necessary in order to achieve the expectations that the fund's investors have. That is, sort of tripling their money. Now, when you kind of look at this, you think, well, how does the math work on that? And and the answer is, well, for example, you could take $1 million, if you had a company that was a winner, and those can sometimes be considered companies that either double or triple in value every 18 to 24 months or so. That if, at the A round, there was $1 million investment, then at the B round, that investment will be worth $2 million. At the C round, it'll be worth $4 million. And at the D round, it'll be $8 million. And if the exit, it's, doubles again, it could easily be 16x or greater. And so in terms of answering some of these questions with respect to revenue or profits, it's going to depend a little bit on the industry. Obviously, if you're in an industry like life sciences where it is regulated and you need to get approval before you can go to market, there's going to be no profit whatsoever. But again, sort of generally the thesis is, they're making investments that have the capability of returning, the entire fund, or in connection with, a couple of other investments, well, basically return what is necessary for the fund to make its hit its expectations with its investors. Versus, you look in, for example, maybe the consumer packaged goods space, and, those VCs may be focused on making sure you found product market fit. And in order to, as an assessment of that, they'll be looking at revenue growth and or profitability. So it's going to depend on the VCs in the particular market that you're in. But, it's very common for there to be, companies that are not profitable, but that are showing great traction that get funded. And I'll leave it at that. How do investors view dilution? I mean, they view it as a necessary part of the game. Obviously, they want dilution. So, they don't want the dilution to interfere with the return that they're seeking from their investment over time. But, they view it as part of the game. And founders should also view dilution as part of the game. That's actually one reason, the primary reason why I've included that slide and included this discussion, because I think in order to know how to do a venture capital financing, you need to understand how the model works. And so that's what I'm trying to show here. All right. Sorry, I'm just checking out a couple of other questions real quick. All right, I'm going to keep focus on the presentation, and then maybe we'll come back to some of these questions because they look like good questions. All right. So we've talked about a traditional investor. Talk about angel investors. They've got different considerations. These are usually wealthy individuals or groups of wealthy individuals. Maybe they are previously successful entrepreneurs. They want to go back and see, the industry or the vertical that they came up in. Maybe they're wealthy individuals and they are looking to diversify their portfolio. That is basically have access to emerging companies as an asset class, right? Maybe they've already got a lot of stocks and bonds and real estate and they're looking for something else. Maybe they like the particular vertical or the goal, the technology that the company is bringing to market. So we see this a lot in climate and energy sector, as people are very focused on trying to reduce carbon and find solutions for carbon and reduce greenhouse and methane and other greenhouse gases. And strategic investors also very, very active in this space, especially coming down earlier and earlier in the company's life cycles these days. And they have different motivations as well. Maybe they are focused on creating or increasing their market, right? If they're a company that produces widgets, they want a whole bunch of other companies out there that need to buy their widgets to put them in theirs, right? To increase their market. Maybe they're looking to, maybe they're looking to have, maybe they're not great at innovating. And so they want to have a pipeline for talent, and they want to have a pipeline for innovating products that are in their particular space. Or maybe it is a financial play, but they've all got different plays and you got to pay attention to those. So in order to find good investors, I think it makes sense, if you're a company, to think about, this is going to be a 7-10 year play. Who's going to be a great long-term partner for us? What are their motivations? How will they add value just beyond dollars? Because, sometimes if you're getting investors who are just motivated by the return that they can get, they're not going to have the right, and especially if they're not experienced with emerging companies, there can be a lot. If you hit a roadblock, if you hit a point where your company needs to pivot, they might be an impediment to being able to come up with a solution to navigate that challenge. So that's what you're looking for. You're looking for investors that will be supportive of the company. You can run a process, I always recommend, and what I see my successful clients doing is running a process where, they've got more than enough capital in the bank prior to raising, right? They understand in a good market, maybe it takes 6-9 months to raise. In a tough market, and we're kind of in a tough market right now, it could easily be 12 to 18 months to raise. And they don't get themselves in a position where they're going to allow their lack of funds to get leveraged against them. And they make sure that they put together a big enough funnel, right? There's any number of articles out there, and I sort of say this because they resonate with me based on also what I've experienced by proxy with my clients. Like, it takes a lot of no's to get to a yes or a yeses. And by a lot, I mean, you could be talking to 40, 50, 100 different VCs, before you get the one or two that really get it, that it's a good fit for. And you got to have, you got to have that outlook, you got to have that funnel built, and you got to have the time to be able to run that process. So what makes a good investor? Think about what is motivating them. Think about what's going to happen when it's not, think when you hit bumps in the road and you may need to pivot. And also you can run diligence on investors as well, right? So a lot of information is available on the internet, TechCrunch, Crunchbase, PitchBook, investors' websites, et cetera. And then if you get, you start talking to a VC, and you start talking to get in the term sheet stage, you can ask to get connected to a portfolio company or a portfolio company, the founders of a portfolio company that has exited. You can talk about, what happens if you hit, what tough points did you hit? How was that navigated? How do they add value? What other things like access to suppliers or talent pipeline do they have for you? Think about those things. All right, I'll pause here and just see if there's anything that's particularly on point in terms of questions. I don't usually monitor the chat. Okay. Can someone just respond and say, is my presentation a bit visible? Because it looks like maybe someone's indicating that it is not, the presentation is not visible. Can someone just respond? Yeah. Okay, great. Thank you. Thank you. Thank you so much. I was like, oh my goodness, I had that set up beforehand. Okay, super duper. Thanks. If you desire the presentation, that's a great point. If you desire the presentation, feel free to send me an email at jason.gordon@klgates.com. Happy to send it to you. I'm going to change my name just to reflect my email. And then you're also welcome to connect with me on LinkedIn, which is Jason Putnam Gordon on LinkedIn. The best way to message me is email, not communicating via LinkedIn, but happy to connect. And then you can keep in touch. And let me just see if I can change my name here. So funny, before I started, I was like, there's one thing I forgot to do. And I realized I didn't change my name. So let me just change my name. I have it set on LinkedIn, and it's supposed to keep, but it never does. It never sticks. All right. So preliminary considerations. All right. So you're going to want to make sure that you got the right corporate structure. And this is a very different sort of presentation that I can give. So I'm not going to spend a lot of time on it, but that's usually a Delaware C Corp if you're here in the United States. I'm not equipped to comment on what's the right structure if you're outside the US. But if you're in the United States, it's 95% of the time a Delaware C Corp. It's really important to also think about modeling your round, that is creating a pro forma cap table. If you're interested in this information, I will, I've put together some content that is on-demand video content that handles it in sort of bite-sized chunks, talking about corporate structure and formation through safe and convertible note financings, through preferred stock financings. in my follow-up email when I send you the recording, I'll put that in there too, so you can take a look at that if you're interested, and if you've got feedback on it, I'd appreciate it, because we're about to be in the process of refilming it and then launching it in a, in its actual iteration, in its version 2.0. So think about correct structure, think about modeling the round that way, and we'll take a little bit more time with this in a moment. And then deal style, is this going to be style based on the National Venture Capital Association's form documents, which at this point, 10 years ago, very uncommon to use. As we sit here today in 2023, I'd say probably 95% of the deals that I see are done that way. If not, they're sort of NVCA light, which is like taking a bunch of the NVCA docs and stripping them down and pulling out a bunch of stuff. And then probably a handful of deals we see will be based on seriesseed.com deals. There's some pluses. And then others will just be, I think, the law firm sort of proprietary law firm forms. Not that they're like truly proprietary, but they're forms that the law firms really typically use. Figure that out, because it does impact a number of things, including sort of the cost of the deal, sort of more, pay more on this deal, but with the ups, typically in the MVCA, you sort of say, well, this is a set that we'll be able to use for all of the later rounds, and we'll be able to layer on it, versus the series seed. It's usually a little bit less expensive to do today, but in your next round, you'll probably need to spend more money in terms of getting an MVCA style deal in place, because that's what you're going to need. And a seriesseed.com deal is not going to have that. It doesn't have a number of rights like registration rights or anti-dilution rights, or a bunch of other things which we'll talk about in that style deal. So as we sort of think about, let me just move this over here. As we think about modeling, I want to walk you through maybe an example of what would be a series A after a series seed. And again, don't take these numbers as this being the right way or the only way to do it. It's just for illustrative purposes. So you got what's known as the pre-money valuation. So that's, by and large, the value of the company before the next round of investment comes in. Post-money valuation is the value of the company after that new money comes in. So you should be able to figure out the post-money by taking the pre-money, adding the amount of investment, and that's what you got. It can be a little bit more complicated, but we don't need to go there right now. And then sort of the common definition of fully diluted basis is all common stock and any rights that can be converted into common stock, or that may become common stock. So that would include preferred stock, warrants, options. By custom, we usually include the option pool in there. Also safes and convertible notes. And the other thing that I want to mention is, and this gets confusing sometimes, but there's something in your certificate of incorporation called authorized stock. So that's the number of shares that can be issued and the types of shares that can be issued in the certificate of incorporation that gets filed. We don't usually count authorized stock when we're talking about dilution and trying to figure out the fully diluted basis. It's really all common stock and anything that can be converted into common stock. Now, the other question that comes up is like, what's the difference between a series seed and series A round? And, these days it's really just branding. Many times founders like to have, a big series A, or, and if it's not a big series A, they'll call it a series seed or something along those lines. But, it used to be a little bit different, where usually, previously series seed really meant seriesseed.com, but it's no longer that way. There are a lot of MVCA style deals that are called series seed. So doing some modeling, and again, that resource that I put together, the Venture Capital Training Camp resource, which I'll share with you afterwards, which is in beta, we actually go through with spreadsheets and I pilot them and drive them around. So if you got the stomach and the interest in that type of thing, you're my kind of person, but you can check it out there. I'm not going to bore the rest of you folks with that. I just want to say, like, okay, so here's maybe a scenario where you've done a series seed before and you're going to go out and raise your Series A. And you can see maybe you don't have as much, of the company as you sort of thought, because there are a whole bunch of other stakeholders there. So taking a look at the we're talking about pre-money here, what the cap table looks like pre-money. Maybe you've got 20 million shares out there. It's split up sort of on the founders and maybe a couple early employees. But, at that prior round coming out of that first preferred stock financing, 5 million shares were sold and so, they've got 13.51%. There are some options out there because there were some hires afterwards. Maybe now is a decent time to sort of segue and say, like, option pools, rule of thumb is 10 to 15 to 20% after the round is closed. But, really the analysis that needs to get done is like, who your hire is going to be between this round and the next round, and what kind of equity awards do you need to give them? That's really the exercise that needs to get run, not just the rule of thumb of we'd like to see 10%. And of course, you need to make sure you've done the analysis of these are the hires and this is what we're going to grant, but you also got to have a little bit of, room in there, I think, because, there might be either somebody who's a great hire that's going to require additional equity than you are budgeting, or, maybe you'll come across some great talent you want to pick up. And you can see, that sort of X converted basis for convertible notes and safes here were a couple points. And then, the remaining option pool that's not yet issued, right? So this is available. This is what I was talking about before. So that's why you see, in this example, it got topped up prior to the round closing. It was equal to 8.65%. And so after the round closed, there was 6.92%. So again, this hypothetical company did the math. Oh, I'm sorry. Okay, my apologies. So this was what was remaining prior to the round closing, and then the new option pool. This should really say option pool increase, probably is a little bit better, but it got topped up or increased. So you can see actually this is what kind of gets you to the 16%. And then you can see the new money is walking away with 20% of the company. And so you can take, pre-money valuation of 40. Post-money valuation of 10 million. So the pre-money valuation of 40 million, investment of 10 gets you to post-money valuation of 50 million. And so easy math on that is you take the new money divided by the post-money valuation, and that's the percentage that they're going to get. So basically they're going to get that many shares. Now, of course, in these deals, they're a little bit of rounding, so things could be up or down a share, but for this purpose, it doesn't matter. So I'll pause there and see if we've got some questions that are kind of applicable to some of this modeling. Question about, will there be a replay? Yes, we'll follow up in like probably less than a week with a copy of the recording, so you'll be able to replay. That. Question about a little more distinctions between seed versus Series A financing. Yeah, I mean, again, it's really all branding and marketing and positioning. So in one sense, there are some deals where there is zero distinction between a Series Seed deal and a Series A deal. The only difference is what they're called the stock that's getting sold. That's it. So there can be, rounds, $5 million Series Seed rounds, $5 million Series A rounds. There could be $50 million Series Seed rounds, 50 million or larger A rounds. I mean, usually kind of if you start getting up in the tens of millions, it might go to an A, but not always. And then if you're really interested in understanding kind of what the difference of the terms are, or what so that's one thing, there's like no difference. But if you're looking for like a concrete difference into what might be in something and what might not be, if you take a look at the SeriesSeed.com deal docs, you could see versus the NVCA docs, you could see, well, if we did a SeriesSeed.com deal, the follow, and I'll talk about this on the next slide, anti-dilution protection wouldn't be in there. Registration rights wouldn't be in there. But again, like much of it is branding, because there can be Series C deals that use the NVCA forms. And there can be Series A deals that use the NVCA forms. So there's not that much different. Okay, just kind of clearing out a couple of things here. I'm going to take a All right, so let's move on to term sheet negotiation and typical term sheet terms. And prior to doing that, I mean, let me try and sort of set the stage again. We usually see successful clients running a bit of a process, so the company has gotten far enough along. If they're in a space where it will be typical or normal to have a product, have it at market. Again, maybe it's a SaaS software company. So they've got some initial customers. They're starting to get some revenue. Or, maybe it's a consumer packaged goods play, and they've got their chips or their beverages or one of any of these things, as opposed to some of our life sciences clients, right? Which, you can't take a drug to market without getting approval. If we're kind of talking about the sort of common one and one where you'd expect to see revenue and customers, and we would see, there will be that story that the entrepreneur can tell in terms of product market fit. We've got more customers than we know what to do with. We can't fill all of our orders, or we can't implement. We've got a great SaaS company. We're signing up lots of customers, but we need to hire more sales implementation people or something along those lines, right? And so we need to get money. We need to raise capital so that we can meet the demand for our product or our service. If you're in life sciences, well, maybe you have gotten sort of, far enough along in terms of the proof of concept or the prototype. Maybe you've already been able to do some limited testing or not. I mean, but for whatever space you're in, you've gotten to a point where the venture capitalists that play in that space are going to be interested in investing. And then you put together a process. So you've identified, who you want to go to, and you've started to run a process to do that. Now, many times it's an introduction from like a trusted service provider is one way that you can, connect with those folks. There are other things out there like pitch competitions that come up from time to time. There are incubators, there are accelerators, there are, always the cold emails that go in, right? But, usually what will happen is, you will have a conversation, you'll kind of pitch your slide deck initially, you'll have a conversation, and then you might get invited back for a further conversation. And that's where things kind of start to get a bit more serious. There'll be some additional back and forth. And if you're going, you get to that point, and maybe you're running a process. So maybe you're hopefully doing this in parallel with a number of different funds. Hopefully you get to a term sheet. And even before the term sheet, you should be thinking about how much of the company you're willing to sell. What is an ideal term sheet for the company, right? And you're feeling that out in the market. And, if you've got unrealistic expectations, hopefully the market is resetting them, and you're moving ahead. And you get to a term sheet. And so what are the typical terms and what do you negotiate in a term sheet? So if we're thinking about the most common sort of MBCA style deal, we're talking about first and foremost, how much of the company is being sold and at what valuation, because that, what the investment level is and at what valuation translates, hopefully you saw that from my prior slide, to how much of the company is being sold, right? So in that prior slide, it was $40 million pre-money valuation, $10 million investment. After that investment, company's worth $50 million. So of that 50 million, 10 million is the new money. So that's why 20% got sold. And that's like very common, sort of a 20% plus or minus 5 or so is common in early stage companies. That is probably the largest term that gets negotiated. modeling it out ahead of time for that round and at least the next round, and maybe even the round after that, is important. So you can get ahead and understand what the dilution is going to look like. Also in there, I'm just going to move down one column and then move down the other column. In that term sheet are dividends. So those are distributions of cash and maybe additional equity that go to the shareholders. That does get negotiated, but not particularly heavily, but you would expect to see that in there. Liquidation preferences. So this is who gets paid first if the company gets sold or goes under. And those are negotiated. In the last couple of years, it have usually been pretty company friendly. The investors would get the greater of their money back, or if they participate, or if they were converted into common. But we're starting to see with the market getting a little tighter that valuations are starting to take a dip, and there are more investor friendly terms. Voting rights and protective provisions. So we're talking about, under what circumstances does the preferred stock get to vote on different corporate actions, like selling the company, or increasing the option pool, or do they have a blocking right on that? So those two things typically kind of work together. Mandatory versus optional conversion of the preferred. So, preferred stock, because we haven't discussed it yet, preferred stock is stock in the company, shares of stock in the company that have preferences in addition to what the common has, right? So the common typically just basically has the right to elect the board of directors and receive dividends. These growth companies usually don't have dividends, at least not early on. So that dividend one, you don't need to pay too much attention to. But preferred stock has preferences in addition to that. So, those are the rights to, among other things, get paid before the common does if the company gets sold or gets or goes under. Has a right to vote on, or has a blocking right on certain transactions. Whether that is selling the company or entering into certain commercial transactions or agreements. Convert into common stock, which is what I'm referencing here when we're talking about optional versus mandatory conversion. So, optional means they can choose to do it at any point in time. Mandatory, and when they usually have that, versus mandatory means under what circumstances do they have to convert into common. And so one that we typically see is in connection with an IPO, right? So you wouldn't want to necessarily have anybody have preferred stock outstanding when the company does its IPO. So you got to have a mechanism to force them to convert. Sometimes you will see a legal opinion. So that's usually about the capitalization of the company. Why is this important? Again, investors are putting their money in primarily in exchange for a certain portion of the company. And so they want to know, and they want to feel comfortable that someone has actually taken a look at the corporate books and records, and the cap table is what it purports to be. So that's where the legal opinion fits in. They are not, especially for early stage first preferred stock financings, they're not very common, but they are there. And it also depends a little bit. I'd say they're not that common in Silicon Valley deals, but other deals they're a little bit more common. And they're kind of, and the reason why they're not as common is they're expensive to do. It takes a good amount of lawyer time to come in and diligence all that and tie it all out. So it's one reason why they're not super common. Rights of first refusal and co-sale. So these are basically rights that the founders and other key employees would subject their shares to, that would compel them to first go to the company and then later to the investors if they wanted to sell their stock. And co-sale means that if neither the company nor the investors wanted to acquire the shares of that key holder who's selling his or her shares, or their shares, then the investors get to come along and sell along with him, get some liquidity. This is primarily about controlling who's on the cap table. to the benefit of the other shareholders in the company sort of for the long run. Drag along agreement is going to be critical to see in there. The drag is under this, basically under what circumstances will primarily the key holders have to agree to sell their shares of stock. So, and sometimes it's also, it also apply to, more rank and file employees, but this is so that you can't have a shareholder bring an appraisal action, or it limits the chance that a shareholder would bring an appraisal action in the event of the sale of a company. And appraisal actions are expensive, and they can kind of tie up / muck up a deal if you're trying to exit. And remember, investors are trying to get the return on their capital. And so they're looking at ways to not only get the upside, but also minimize risk. Registration rights, these, and I think actually even drags, my recollection, I don't think drags are, I just don't remember because I insert them a lot in SeriesSeed.com deals, but I think they're negotiated to put them in there. Registration rights, those are rights which compel registration of the company's securities on the public markets. Those are not in SeriesSeed.com deals. They're in NVCA deals and most other venture deals. Same thing with anti-dilution protection. So that's if the company were to raise a round later at a basically flat or lower valuation. Super critical, vesting for founders and other key employees. Investors are going to expect to see that in there. If you've never had vesting in place for your company, you're going to need to get that in place at or before or in connection with the financing. If you've already had vesting in place, but you're basically fully vested or substantially vested, you may need to reset some of that. Who takes care of the documentation? Is it the company lawyers or the investor lawyers who drafts? Attorney's fees are negotiated. It's very common for the lead investor to have at least a portion of that investor's fees covered by the company in connection with the investment. It's customary for that to be capped at some negotiated amount, not uncapped. Investors don't want you to shop your term sheet to other investors. So if and when you sign, you're going to be not going to be able to shop the deal, and you have to keep it confidential until the deal closes, until the deal closes. And then, of course, the always negotiated board seat. Will investors get a board seat or multiple board seats, or will they have an observer seat? And all these are, in one sense, up for negotiation. And what happens is usually subject to who's got the bargaining power in that deal. Is it more on the company side? Is it more on the investor side? And pro rata rights are rights for usually certain investors, usually the larger investors, to participate or buy shares, keep their percentage amount, basically their pro rata amount in the next round. And that's important because I said at the outset, these companies frequently take multiple rounds of investment to scale. Investors don't usually put all of the money in that they can. It's a way to sort of hedge risk, sort of maybe dollar cost average, or maybe reverse dollar cost average their investment, but also maintain their percentage in there. So those are negotiated and important. We are covering a lot of ground. I got a couple more slides left, so I'm just going to take a quick look here, and then I'm going to keep chugging along. Okay. Deal documentation. So we've already kind of covered some of this. There are the main documents, which are the stock purchase agreement, which conveys more or less how many shares are getting sold, and factual statements about the company by the company, and factual statements by the investors about the investors, some closing conditions and other things. The amended and restated certificate of incorporation. So whatever certificate you've got on file is going to need to get amended and restated to reflect the rights that the preferred stock is going to have, whether that's liquidation rights, voting rights, their preferred board seat, etc. The investor rights agreement. And, if you're interested in taking a look at this, I encourage you to go to the nvca.com or .org site, look at their docs. You can look at their sample term sheet, which typically isn't used that often, even though their docs are usually used. And you can look at their docs and they're annotated, and they're very extensive, like very thick. But, you know, if you'd like to get in the weeds, I encourage you to do that. Investor rights agreements contain the registration rights and information rights and some other rights with respect to, you know, corporate action and governance and things like that. Voting agreement governs, you know, who's on the board, how do those members get on the board, and the drag along that we talked about. And then, you know, the right of first refusal and co-sale agreement, we've already talked about what that is, and that embodies it there. But that's not the only deal documentation that gets done. So many times every time there needs to be board and stockholder consents approving these transactions. Many times there are already investors with rights or other things out there with rights that are outstanding. And so those either need to get terminated or waived. We'll talk about side letters in a minute, but there could be side letters in connection with that. Everybody needs to agree on a pro forma cap table by the end, potentially a legal opinion, and then all of the cleanup work that, you know, all of these companies, you know, it's understood in emerging growth companies that most of the resources are going to go to building the company, right? Building the product, building the teams. It's not going to go to legal perfection. And so many times there's some cleanup work that needs to get done. Not every time, but most of the time there's some work, maybe some deferred maintenance that needs to get done. So that gets taken care of at or before closing too. And if it can wait till after closing, then many times it is a covenant that either appears in a side letter, that is a promise that appears in a side letter agreement, or sometimes it's tucked into the investor rights agreement. And side letters are agreements that are outside of the main financing documents, and they commonly cover things like information rights, observer seats, pro rata rights, which we've talked about, or, you know, if you're dealing with a strategic, sometimes there are commercial agreements that get put in place in there. If you are on it with a company, you know, you should understand that it is common to get these, but it's not necessarily common to have every single investor, and you wouldn't necessarily want every single investor to get every right that they could have. And so not every right that they could have, but you need to be mindful of the burden that it places on the company when you're giving out these rights, because, you know, frequently other investors will see them. They need to get disclosed most of the time, or if they're not disclosed, there will be some provision that says there are no side letters, and so you'll need to disclose them. And, you know, if one investor sees it, then other investors typically want it. And so, you know, you need to have cogent arguments as to why it makes sense for some to have some of these rights and others not to have others. Many times it will deal with either specific sort of eccentricities that an investor may have, like maybe they are, you know, a reporting company and they have got obligations that they'll need to report, or, you know, maybe they're in the commercial space and, you know, again, they need these commercial terms or something along those lines. So you just need to be strategic about it, because you'll need to honor it. They are legal agreements. And you'll need to also know that investors down the road will probably see them. And so, you know, one problem is, you know, you give everybody pro rata rights, and then, you know, you may have a problem if, you know, you're doing really well for the next round and there's not enough room to give, you know, to bring in the new money and give everybody their pro rata rights. In one sense, that's a good problem to have. In another sense, you should be trying to think at least a step or two ahead. So let's talk about diligence process. So what you would see is that an investor would set up a request for information. It'll be like a 7-page long document where they will ask for all, and it's broken up on topics, you know, business related topics, corporate structure and sales of stock, you know, IP related issues, whether or not there's material contracts. So like the forms of your employment agreements, the forms of your contractor agreements, and each of your contractor and employees agreements, litigation, you know, and then sort of miscellaneous catch-all. Oh, here we go. I didn't realize I had this list right here. And then, you know, we put the responses in a data room. It's kind of like, you know, at least here we have and usually host our own data rooms for our clients, but you can think of it like Box or Dropbox with a bunch of folders and listed based on whatever the topics are. And then you'll need to put each and every one of your agreements in there. And so let's talk a little bit about the interface between deal documentation and diligence. Diligence is the process during which investors obtain information about the company to identify and assess the risk of investment that they're making. Deal documentation is, we already talked about sort of reps and warranties. So these are factual statements. I'm going to focus on the company side, but factual statements by the company in the stock purchase agreement, which provide information about categories of risks. And so if there's an issue, like let's just say, you had a contractor and that person never signed a contractor agreement and didn't confer the IP over, that will need to get disclosed to your investor. Either the rep needs to change or it needs to end up on the disclosure schedule, which is basically a list that we put at a very extensive list that we put on the end of the, at the end of the agreement that modifies some of the reps. And you'll need to disclose it. And then you'll need to come to agreement about how you're going to fix it if you can't fix it. Now, maybe in the case of that contractor never worked on any material IP, right? So that's, intellectual property of the company that's going to sort of matter or affect its business in a way that's going to be meaningful or have a sufficiently significant impact on the business. So maybe it doesn't matter, but you'd still disclose that. The other way, as I mentioned sort of before, is sometimes these cleanup items can happen prior to closing. Sometimes they happen after. If they happen after, then it's going to be done and taken care of in connection. There will be contractual obligations to do that. Closing and post-closing issues. So the typical order of operation for closing. All right, you've gotten through diligence, you got all the deal docs finalized. The order of operation is usually there's going to be a board consent or a board meeting. It's then going to go to the stockholders who will approve it either in a consent or a meeting. Then there's going to be a certificate of, then the amended and restated certificate gets filed, and then the closing can happen. And sort of mechanically, and there's still not like, you would think you just press a button, and there are some companies that are working on that. And, we do use some resources that do facilitate it and make it a lot easier than when you used to have just paper. But usually what happens is that everybody wants to see everybody else's signatures. So the lawyers get a hold of them and hold them, and they don't get released. They're basically kind of held in escrow pending everyone's final sign off. And usually kind of once the wires get initiated. And then after that, the work isn't done, although most of the work is done. There are securities filings that need to get made. So, sale of preferred stock is the sale of a security. So, in the course of this, you will need to make sure that you're complying with all securities laws. Many times in compliance with those laws, you'll need to make filings with various states or, if you're outside the US, with those authorities. Stockholders who didn't vote in favor of the transaction, either because they just didn't vote, that you'll need to provide them with notice. That's the 228 notice. Folks want certificates, used to be paper, but many times there are electronic providers that get used. And then most of the stuff gets packaged up. I would say typically what we do is we put together a closing, on company side, we'll put together a closing binder, which will have all, it'll have a table of contents and then all of the deal documents that were done in the deal. So there's one standard place, and I'll tell you, it takes a bit of time initially, although again, there's some resources we use that are helpful in speeding that up. But it saves a ton of time later. And then it gets circulated. And, when I'm investor side, we certainly look for and chase after that closing binder. So we're coming up at the hour. I want to take the Q&A, but let me just hit a couple common pitfalls first. So negotiating before you run a proper pro forma for kind of, that is, you've done your modeling for this round and the next rounds. If you don't do this, like the primary action that's occurring here is you're selling a piece of your company. And if you haven't done the model, you don't know what you're selling and what you're going to have left to sell later. So it's just super critical. Securities laws, not, and sort of related to that, using finders. So again, you need to comply with securities laws, make sure you've got exemptions, make sure, depending upon which securities exemptions you're relying upon, you're likely going to be going to accredited investors, and, it's going to be somebody within your network or that you've got a substantial relationship with, prior substantial relationship with. Obviously, if you're a fraudster and you're selling a bogus company, you can end up going to jail. But, lots of times, if there's a sort of a bust or a non-compliance with security law, it's not, it's not jail that, because most of the time it's not a fraudster. Because of that, the real thing that you need to be concerned about is whether or not the deal could get unwound, rescission. And so you need to comply with that. Having finders, these are people who are out there who are offering to connect you to money in exchange for something of value. Unless they're registered broker dealers, you need to make sure they've got, there's an appropriate exemption you can rely upon in connection with working with them. Otherwise, you're going to end up potentially in a situation where the investors are paying attention to this. And we certainly something we diligence when I'm investor side, and they're asking for reps on it. And, if the deal gets done and you've got these people involved and it's not been disclosed and there's not an exemption, then potentially they get to a right of rescission. That is, they get the right to get their money back. If you don't have the money, or even if you do have the money, unless you're like, your company is doing great and, you can afford to give them their money back, it can be company killing. Poor record keeping just keeps to a lot of cleanup. So, although nobody expects startups to be perfect, the less perfect they are, the more expensive it can be, and the more difficult it can be to clean things up. You've got an employee or a consultant who leaves. Maybe they didn't sign an IP agreement while they were there. If they're on their way out the door, maybe that's a great opportunity to get a separation agreement in place. Pay for it them. They're incented to take some extra comp and sign it. And then you got a clean record for later. You go back to them a year later or 2 years later, they've already found another job. They never liked, they're unhappy with the split up, and it might be hard to get them to sign anything. And related to that are napkin promises, just, promises, although, on the back of a napkin saying, thanks for collaborating with me over this drink, I'll give you 10% of my company. More likely these days, it's like emails and statements. And you got these things. And, again, investors want to purchase a certain percentage of the company for their dollars that they're putting in. And napkin promises make it unclear in terms of how much the company, who owns how much of the company. All right, let's take some questions and comments. Thanks for hanging out with me if you've made it this far. Don't hesitate to reach out, jason.gordon@klgates.com. Or connect with me on LinkedIn. Messaging me on LinkedIn is not a great way to communicate, but I certainly would be delighted to connect, or at least it's not a great way to communicate quickly. All right, so I'm not monitoring the chat, but I am going to monitor the questions. Yes, so for the person who asked if I can write down my email, I did put my email in my name. So if you just kind of look at, it's Jason Putnam Gordon. Excuse me. Yeah. And then you look over next to my name, it's jason.gordon@klgates.com. I guess I can put that in the chat. Here we go. Super duper. Okay. Question about how does this change that the company is mainly going to license or sell its IP to other companies? Well, I think the answer to that question is really like there's a well-worn venture model. I've articulated what it is, which is that there are, funds out there. The traditional model is there are funds out there that are looking to make high risk, high reward bets, that will, over the course, for a fund that lasts, 7 to 10 years or so. And they're going to try and sort of 3x the money for their investors. If your licensing play kind of hits those finance metrics and models, it doesn't change at all. If the play doesn't hit it, then you're probably not in venture, and that's probably a topic for a different conversation as to who might be a good investor for that. Question about nvca.com. I'll put that, I think it's nvca.com or .org. Let me just nvca.org. And I'll put that in the chat too. Bear with me one second. Let me there's one other resource I feel like. Just see if I can get you one other thing. Bear with me one more second. I apologize. Got a lot of tech going on here. Oh, so many windows. This is what, let me see if this will work. Nope, that didn't work. Don't go there. But I can click here, go here. This is the on-demand resource. I just put that in the chat too. If you want to check that out. Now let's see if I can find the Q&A window here. I've got so many other windows open. I'm going to stop the share. Oh, there we go. It's live, done. Oh, it says that, okay. So for the person who can't see my email, I'll put it one more time. Oh, that's why. All right, I'll put my email in the chat. Hopefully that's gone to everybody. I will put that resource, that beta resource that I put together in the chat. Thank you for hanging out here with me. And then I will put the NVCA link also in the chat if you want to check that out. There we go. Okay. What happens if the deal closes? Does all the money get immediately distributed to the startup? Yeah, I mean, that's by and large, yes. If that's the deal, right? Most of the time the deal is, if you're raising $10 million, you get all the money up front. Now, that's not it on every play. Sometimes the money gets dispersed in tranches. So for example, I've worked deals that's involved, like InsurTech or something along those lines. And so it would close in tranches. So for example, 5 million of that will come in at the initial closing. And then if, for example, that company got a license, by X, Y, or Z date, the investors would be contractually obligated to purchase the next $5 million in shares of stock. And so that's how that works. There's somebody who's got a question about, hold on a second, let me just see this. Oh, someone's asking about convertible notes. Okay, so that's actually like a different topic, but I will. The question is basically, if I understand the question correctly, the question is, if I've got a convertible note that's got an interest rate of 5 or 6%, does that get paid out as cash, or or does it get paid out as stock when the note converts over? So usually the convertible note is accruing interest, and the interest will get converted into shares in connection with the preferred round. That's common. Again, you want more information on convertible notes. You want more information on convertible notes and stuff, you can check out that resource that I put in the chat. Okay, there's a question about a therapeutics company. Any advice on doing a pre-IPO capital raise? So if you're in that space, I mean, I've worked those deals before. I mean, there are a lot of venture capitalists who are interested in those plays if they, believe in the tech. And so I would, and this is, I think, of general applicability, I would go out and figure out, who are the life sciences companies, or excuse me, VCs that are interested in therapeutics. You could probably suss that out by subscribing to Crunchbase, or you could take a look on PitchBook maybe for, temporary access. And you could break out those verticals, and then you can connect with those folks. I know, there are a lot of incubators that also participate in that space too. And so learn the ecosystem. There are definitely, there's money to be raised in life sciences and therapeutics. All right. I guess there's a question about personal liability of founders. And I think when we're talking about personal liability, we're talking about founders having to pay with their own personal assets, right? Like, sell their house, sell their car, liquidate their bank account to pay back investors. At least in the Bay Area and most of the US deals, absent some sort of fraud, that's just not done. Now, we do sometimes see personal guarantees by founders on leases, but even that is sometimes negotiable. And we're talking about venture capital deals, right? So that's different than, you're going out and you're getting a line of credit from a bank or something along those lines. I mean, that's a different play, different investor. Okay, so there's a question about who I am and why am I talking about this? They're talking about today. So I am an emerging growth and venture capital attorney. So I work with companies as they raise venture capital financings. I work with investors as they deploy capital into those companies in venture capital financings. I do from time to time get to play matchmaker, but I certainly don't, sell myself as saying like, sign up with me and I'm going to connect you to capital. I think, anybody who's honest, who I don't think there's anybody who's honest that would, be able to make that guarantee. So yes, and in terms of verticals, and I play a lot in the climate and energy and life sciences space, but I also have a lot of experience in autonomous vehicles and AI and software. And I just love it. And I love getting to work with all these energetic companies. And I love working with investors as they deploy capital into these companies, because it's just so wonderful to see, something go from an idea on like a whiteboard to scaling with hundreds and thousands of people, hundreds, and then thousands of people working for it. So that's who I am. Again, if you want to have a conversation with me, I do keep office hours. So feel free to email me at jason.gordon@klgates.com. Let me just see. Do I help with structuring funds? I have partners that are in our funds group. They're actually called asset management attorneys. So the folks, I know it's very confusing, but You can be in venture capital. So usually you kind of end up in one of two places. You either sort of end up on the company or the deployment side, which is where I am, right? So I work with companies and raising, and I work with investors as they're deploying, or you end up on the sort of fund formation side. And so there's a different set, but we certainly work with those people. And so if you're, raising a fund, it's usually probably a fund that's going to be 50 or 100 million or up. Potentially we could be a fit for that as well. If the board, so there's a question about, I'm just not following this question. This question is about if the board holds a minority stake, can we impose a limit where capital must be added? I'm not sure what that means. But it sounds like you're going to reach out to me on something else. So maybe we can talk about this at that point. And then yes, there's another question about negotiating specific terms with the VC. I'm happy to discuss maybe during office hours. But again, you got to remember what their model is. So, usually if they're not just looking to double, they're looking to get a home run. They're looking to, I run a lot of panels, moderate a lot of panels with VCs on them. It depends on the VC and their thesis. I've literally heard some of them say that they are looking for 100x return. I've heard others kind of down more in sort of 10x, 15x, 20x. Again, it depends on their thesis. So, I would sort of question, if you were going to propose to a VC like doubling their money, does that really fit in their model? And if it doesn't fit their model, might not be the right fit for them. Okay. Then we got a much better than 10x. Great. Okay. And honestly, also that return also depends a little bit about where the company is in its life cycle, right? It's sort of easier to get that 30x return all the way in the early stage, right? Because that company has got to go up in hockey stick and it's going to double or triple and double or triple and double, triple and double, triple. You only have so many doubles or triples left towards the later stage. I've got a question about if you are a new citizen, is it possible to run a venture capital fund? It certainly is. Our funds formation folks would be in better position to address that question. And with that, there are still people in the room. I appreciate your time. I'll take a sip of water and see if there are any more questions. All right. Well, if not, I want to thank. All right, let me start over again. I'm gonna have to edit this part of the video. Looks like there are no more questions. I really appreciate the opportunity to present today. Thank you so much. If you are live, thank you so much for attending. If you are on a time-shifted basis, thank you again so much for attending. I want to thank Idea to IPO for organizing. I want to thank my firm for supporting this event. Again, we will follow up with the video within about a week or so. And if you want to reach out, feel free to connect with me on LinkedIn. Feel free to send me an email if you want to take advantage of the office hours. My name is Jason Putnam Gordon. It's been an honor. I'm going to let you get back to building your great company.